Good morning. You're watching The Market right here on ET Now with me, Aisha Fariri, Nikunj Dalmia, Avan Dabash, Nayantara Rai as well on the show. And for the market, the struggle continues. Today, of course, is going to be an extremely busy day of trade with the eye on FNO expiry come Friday. Tomorrow, remember, is the trading off, but we're in the thick of earnings and it's the last expiry before the union budget as well. So that said, we are done with 8 FNO as well as 4 Nifty companies which are going to be declaring their Q3 numbers today. So it's a very, very critical day. And yes, of course, the largest FPO ever, that's the Adani Enterprises FPO, that's going to be opening on Friday as well. So lots on our plate.
Yeah, busy day. And then we're forgetting budget, which is next week. So yeah, I mean, you actually in middle of an earnings season and the market action just is not capturing the underlying news flow, if you frankly ask me. First, let's look at the FNO expiry. The FNO expiry is very muted. Rollovers are not there. There is no large pent-up demand in any of the key large sectors. It's like markets are waiting for the event risk, which in this case is budget, to perhaps get over. Then only traders will come back with large positions. And today is the last FNO expiry, so I think a lot really hinges in terms of how things would move on the budget day. 8 FNO companies, 4 Nifty 50 companies. The template still remains the same. Good numbers are getting ignored. Bad numbers are getting disproportionately punished. If numbers are strong, commentary is decent, markets are saying it's in the price, let's move on. And then largest FPO in India, that's the Adani FPO, that will open on Friday. We'll talk about it, but that again will be occupying a lot of center stage considering it's large, big, and surely in the near term, it will have an impact on liquidity.
All right, so a mix of factors that the markets, of course, will be reacting to and that we'll be watching out for. Just to give you a snapshot of the global picture then, the SGX Nifty is indicating at a muted start. You have the S&P 500, the Dow Jones, etc., all a bit tempered in yesterday's trading session. The futures as well shedding a few points, and the overnight action, though, followed that 3-day winning streak for the Dow. And week to date, you've got most of the averages which are up about 1% or so. Lots of high-profile corporate earnings that will keep Wall Street busy. Meantime, across the Asian bourses, it's taking lead from Wall Street's struggle because for some sort of a decisive direction, the China and the Hong Kong markets, remember, remain closed on account of the New Year holidays. For the rest of the basket, it's looking a bit mixed, and that's the SGX Nifty down 47 points. But the other big factor that we're tracking then is the dollar index. From the 2022 peak, the dollar index has seen quite a fall, close to 11% already. And on a year-to-date basis, we've seen a fall of nearly 3% in the dollar index. 4 straight months on the trot that you're seeing that index come under pressure, and those levels of 101 now, those were last seen, Nikunj, in May 2022. So we've come off a long way from that level.
And that is that is the real pivot, if you frankly ask me, that the dollar index in September was at 115. 115 has become almost 101. You go below 101, an important technical level for the dollar strength would be taken out, which necessarily means that in the short to medium term, if the dollar remains weak, rupee surely will strengthen. Other emerging markets will be in focus, and it's a matter of time that money will come back into India as an emerging market basket. So structurally, the weakness in dollar index is always good news for us. Structurally, the weakness in dollar index is always good for commodities. Structurally, the weakness in dollar index is something which has always led to emerging market outperformance. So the template, I think, is getting set that if the dollar index remains weak, emerging markets as an asset class will outperform. Within that, India has underperformed this year. But I think that is pure rotation which is going on because India did very well last year against all global odds. I guess right now other emerging markets are coming back, and I guess somewhere if if we come on the right side of the budget event, if there is no large changes in the taxation front, if the government is committed to really stimulate the economy, and if the fiscal numbers is something which do not disturb the market, then I would seriously make a case for a sharpish rebound in the market post-Feb, considering that the global scenario and the dollar index is favoring us. That's my call, that budget, if this is a no harm budget, trust me,
We're in for some upside.
we are in for some upside, because the weakness in dollar index means good news for emerging markets. Then why are we underperforming? Because we did very well last year. So we have to catch up. Indian
have
bulls
an
are taking it
overhang.
easy. They're just taking it easy. Indian bulls have not gone anywhere. They will come out of hibernation, I'm telling you.
Yeah, absolutely. Okay, the Nifty and the Nifty Bank, the rollovers are below average. So you can see as to how light the market has been in terms of a positioning ahead of the budget. Remember, given that tomorrow is a trading holiday, the expiry takes place on Friday. The premium, of course, is half of December. That's how light the positions are. However, there have been positive rollovers in sectors like IT, auto, as well as real estate, and negative when it comes to pharma, to cement, or for that matter, even telecom. In fact, some of these names from within the sectors have been marked underperformers. That's something that we've seen already. And Nikunj, just looking at the trend decline in premium for the Nifty from December to Jan to now Feb series, which is currently at 86, that's clearly a bit of a telling sign in continuation with what we were talking about, the budget being an overhang.
When the January series started, the premium was almost 130, 140 points. Now we are looking at almost half that premium. It's a very very basic indicator that if the premium is strong, that means the trader is ready to roll over the position at a premium. Now, the good bit here is there is just no interest, there is just no narrative, there is just no excitement, there is just no pent-up demand, there is no inertia, there is no momentum. Am I missing any other word? Pent-up demand, inertia, momentum, excitement, euphoria, conviction, pre-budget trades. There you go. That is the setup of the market, which means that we are going into the event with low positions, no hopes, and very low conviction, despite the fact that last two budgets have been gangbuster. The government has managed to hit out of the park. The budget has been consistent, no draconian changes in the tax policy. I'm surprised why there is nervousness. But for our viewers watching the show, I think this is good news. Because markets are not expecting anything, the scope for markets to come back, I think, are very high. And if I look at the history of what the government has done, there's every reason to believe that this is going to be in continuation of the government policy, and this is going to be one of those no-harm budgets.
Yeah, so perhaps no reason for that nervousness going into the big event, but February 1st is when we'll get all the actual data and the on-ground assessment of how things have shaped up for the Indian economy. All right, let's move right on then and talk about numbers, because yesterday you had some interesting earnings coming in post-market hours, and then today, very busy day on the earnings calendar. So Pidilite, for instance, came out with a mixed set of numbers. It was a bit disappointing in terms of the revenue growth. That was down, that was just about flat at 2,998 crore rupees, and the profits declined about 14%. USL as well came out with its numbers, nothing to really shout home about, with the revenue at 6,609 crores. And then the profits coming in flat at 214 crore rupees. And today, Nikunj, we're bracing ourselves for a whole host of numbers. There's Dr. Reddy's, Cipla, Tata Motors, and Bajaj Auto.
See, if I have to look at numbers which have declared versus numbers which are expected, it's Pidilite and United Spirits. Now, these are two haloed stock. Everyone thought that, these are stocks which will only continue to grow, and these are companies which will only command a premium. Now, this market has seen a sharpish adjustment in some of the haloed stocks. Asian Paints, Bajaj Finance, Pidilite will see some adjustment today. Ultratech saw some adjustment, I think, on Monday, and ditto for United Spirits. Urban focused FMCG companies, urban focused growth companies, I think, are going through a decline. On the other hand, rural facing companies are coming back, whether it is Maruti or the kind of indicator we are hearing from other FMCG companies. Now today it's Bajaj Auto, where frankly markets are not really tracking that number with a magnifying glass. But given where we've seen the Tata Motors stock rivet itself, a lot is expected, not only from numbers, but in terms of fundraise, IPO, JLR cash flows, JLR margins, China opening up. So if you frankly ask me that if you're looking for not 1, 2, 3, 4, 5 headlines, you are likely to get a lot of headlines from Tata Motors today. Cipla versus Dr. Reddy, I mean, the jury is already out that Dr. Reddy has challenges, Cipla is gaining, stock has done reasonably well. not a number which will excite the market any which way. But if you really have to ask about the result reaction, United Spirits could face the music today. Pidilite has underperformed. It will remain an underperformer. And Tata Motors, I'm telling you, it's a number where everybody wants to understand fundraise, IPO, subsidiary listing, JLR cash flow, China opening up, and finally what is happening to the new electric launches.
Okay, so let's watch out for Tata Motors and the kind of commentary that we get in a stock that has, of course, been buzzing. A lot of corporate action also is the way we just got to in our editor's take. Well, every morning, my colleague Anisha Jain compiles a list of all the important commentary that's come out from around the world. It's our global check and the commentary you need to have on top of your mind as we march towards opening bell. Good morning, Anisha.
Hi, good morning. Well, there might be a bit of lack of enthusiasm when it comes to the Indian market, but if you look at the global markets, there's quite a bit of cheer, and that's what Peter Schiff is also talking about. He says that it looks like the Santa Claus rally, instead of December, is coming in January this time around, because the Dow Jones, for instance, is up already 9%, and even Nasdaq has seen quite a bit of rally this year. The reason what Peter Schiff believes is that investors seem to be anticipating a soft landing, inflation returning to 2% mark, as well as an early pivot from the Fed. He believes that the first two will not happen, and even if Fed pivots earlier than expected, that won't be enough to help you do a bit of a soft landing. So those are the important things that he wants to have people on the mind with respect to justifying the valuations that the stocks and indexes are trading at. Mohammad El Arian talks about that this is an investment world that will reward much greater selectivity and dynamic asset allocation. So clearly the word coming in that you have to be a lot more nimble this year. You'll have to pick those pockets where there is a bit of an upside, because rising tide phenomenon might not work across the board. Talking about the word coming in from veteran investor Jeremy Grantham of GMO as well, he believes that there could be a 17% plunge when it comes to the S&P 500 this year. He says that the range of problems are larger. In fact, the greatest that he has seen, remember he's an 84-year-old veteran investor, and he believes that the problems are at the highest than he's ever seen in his own career, and he doesn't rule out a brutal decline to 2000 levels as far as S&P 500 is concerned. Shifting focus to the word coming in from Morgan Stanley, wherein Jitanya Kandhari believes that this is the decade that will belong to the emerging markets. Earlier we had seen how there were earlier decades which belonged to, let's say, US as well as China, but this time around it will be the entire EM pack that stands as a beneficiary, and India too is one of the top trades at this point of time. So definitely something to watch out for. And lastly, wanted to highlight with respect to the earnings coming in from Microsoft, a bit of a soft quarter, but more importantly they're guiding for further softness. They're talking about how the revenue growth in its Azure cloud compounding business will slow down going forward. Remember, this was one pocket of green earlier for them because the rest of the business was declining, but this also is now facing a bit of a slowdown, as well as the corporate software sales and commercial business is likely to see further slowdown. So a bit of a dampener coming in from Microsoft this morning.
Powered by 1 billion consumers, India has now emerged to be the world's fastest growing large economy. In this budget, will the Finance Minister announce measures and policy initiatives that will boost consumption in India? Join me, Nilesh Shah, as I analyze the budget on ET Now.
Right, Nilesh Shah of Envision will be in our Union Budget think tank. It's a powerful think tank, some of the best brains that you have. So stay with us on 1st of February. We'll be getting you the best of analysis of the Union Budget. Right, we've of course been speaking to market experts on what's likely to happen for Dalal Street this year and the pockets of growth, why the needle is not moving, and what's likely to happen after the big event on 1st of February Union Budget. Here's Ajay Srivastava. He has, of course, been betting big on infrastructure as well as capital goods. What he's also been betting big on is real estate, infrastructure development in the northeast, and also because of what's happening with the tea gardens there. Listen in.
If you travel on northeast, you'll find that the government push is very visible. It's visible to everybody. The road which goes on to Burma and the infrastructure growth there. The traffic jams in Meghalaya, you could be sitting in a 2-hour traffic jam in the middle of Meghalaya. You wonder where all these people came from. But the fact remains, Northeast is a reality of growth. which is going to be exceedingly higher than India's growth. Real estate is cheap, of course. Tea gardens are dramatically cheap. That is visible to everybody. The good quality assets which are going around. So I think the Northeast will continue to be a great story. It's difficult to enter the market because you don't, it's like tea is not a great companies that you can invest in. You got to be careful where you invest your money, etc. Real estate is a different play altogether. And other infrastructure plays, you got to be localized to buy that story. But Northeast is a budding story in India, definitely. And India, if it has to grow, commodities will remain the story because it's monopoly. There's no new company can come up. We cannot afford large-scale import in this country. Sooner or later, the copper smelter will start in Chennai. We can't afford to be importing so much of copper in this country. And if you have to grow even 7, 8, 10%, and no major capacity is coming up, the existing commodity companies are going to make money on the play in any case. I find it the safest place where India's growth story will play out will be commodities. Because if commodities don't work, the rest of India's story will not come together. If it doesn't come together, hardly a case to buy a consumer company or any other company altogether.
All right, let's move right on then and chat technical. C. Rudramurthy and Naresh Mirani with us this morning. Good morning, gentlemen. And looking at the trade setup, Naresh, the fact that the Nifty and the Nifty Bank rollover is below average, the premium is half of what we witnessed in December and January. Given that we're languishing ahead of the big event and ahead of expiry around the 18,100 mark, what's your take on levels?
So it's actually become difficult to make a take on the markets till the time the budget is not over. Because what we are seeing is we are not seeing any correlation with the global markets in terms of a daily move. We are not seeing any price action across the broader markets. And if you look at the last 4 days of the trading data for the Nifty, we've been in a band of say 150 to 200 points and almost closing around the same prices of 18,100. So we are still stuck in this band, 17,800 the lower end, 18,250 the upper end. Until the time we don't get beyond this, we have another 4 trading sessions to go before the budget takes place. So for now, the view is just let the markets be as it is, wait for the budgets to get over, and then maybe we get a trade.
Okay, everyone, waiting for that event on 1st of February to be out of the way so that we start to see the needle move. Sectoral Rudramurthy also here with us today morning. Sectoral Rudramurthy, what are the levels you're watching out for when we talk about the index, and what about the Bank Nifty?
Very good morning. I just bit differ from Nuresh's view. Yesterday was the first sign for me where market was telling that yes, I am moving downwards and I am giving a sell call both on Nifty as well as Bank Nifty, and there are reasons for it. Look at results from Axis Bank, so good, but still the stock was punished. Look at even results from few other banks like ICICI Bank, results were good, stock not going up. IDFC First Bank, stellar results, stock coming down. So all this indicates to me that good results are getting punished. Imagine if results are just as per expectation or bad, what will happen? And yesterday was the first sign for shakeout in market which I could see, and for me Nifty has taken multiple times resistance at around 18,250 to 18,300, and even yesterday it respected that 18,250 zone from where market fell. A 100-point gap up open indicated by SGX yesterday was fully sold into. So for me, the levels to watch today for Nifty futures will be a close below 18,050. Suggests to me that next level is 17,800, and a break below 17,800 is all over. But a sure stop loss at 18,250 has to be maintained for the sell call. And when it comes to Bank Nifty, I'm looking at targets of around 42,300 and then 42,000 to come. And if we break 42,000, there will be a free slide down and budget might be the trigger for the same. And again, for this Bank Nifty sell call, I will have a stop loss at 43,000. So sell on rise and 43,000 will be the stop loss on Bank Nifty for a target of 42,000, and below 42,000 you will see a free slide.
All right, let's find out then what are some of the top recommendations. Rudra is talking about 18,050 being a critical level that needs to be sustained. Naresh, what are your top calls?
So first is a buy on ICICI Bank, which is more like a risk reward trade. For the last 5 sessions, it has held on to that 855, 860 mark, which is a support. Till the time it holds, we can see a bounce back towards 900, and 850 to 860 was the price point where it made the biggest drop a year and a half back. So expecting a bounce back from here, a risk reward trade. Second is a buy on GAIL India, which has continued to hold on above the breakout level of 9900. A very strong base made at 85, almost 8 to 10 attempts over the last year, year and a half. And the stock did not break 80, 85. For the last 2-3 months, 99 was a resistance, which was tested 3 times. Now that has taken out and it has been holding well. Expecting it to go for the highs of the last 1.5 year of around 115. A stop loss at 99.
Okay, so today our judges Naresh Varani and C.A. Rudramurthy are not only going to disagree on the levels to watch out for the index, but also what their calls are. We saw all buy calls from Naresh, and C.A. Rudramurthy, I believe yours are going to be all sell calls.
Yeah, Nainatara, for me, definitely banks are showing first signs of weakness, but let it be very clear to all our viewers, metals, IT, auto, these are sectors to buy. I repeat, metals, IT and auto, but then banks, financials, interest rate sensitives, these are areas to go short. So you have to be very sector specific and stock specific. And I have a sell call today, both on the short side, and I'm picking one bank and one real estate stock. Look at DLF chart pattern. Yesterday it has closed below levels of 367, which was a very strong support. Last 2 days, even when markets were moving up last week, DLF was coming down. Look at volumes increasing with every fall in DLF for last 3 days, which clearly signal to me the patterns of sell-off, distribution and also shorting happening in F&O. Take sell call in February month futures. Look at initial targets of 357 and eventually 348 on DLF. Keep a stop loss of 370 for this sell call. And I have a sell call also on Bank of Baroda. No doubt PSU banks can do good for medium to longer time frame, but for very short term as a trader, they have moved up too much. And yesterday you could see that clear weakness coming in Bank of Baroda. I'm selling February month futures of Bank of Baroda. Risk reward is very favorable. Keep a tight stop loss of 181. Look at targets of 170 and 165 on Bank of Baroda.
Hi, my name is Shashank Shrivastava. I am from Maruti Suzuki, and I'll be taking a close look at the forthcoming union budget from the auto industry perspective. Auto industry, as you know, has had 3 really tough years, and in fact the last year was actually good from a volume perspective, but the challenges continue. So I'll be talking about the expectations from the industry regarding how to make growth a reality for this industry. So tune in to ET Now as I decode the union budget from an auto industry perspective.
All right, let's focus in on all the stocks that will be in the spotlight in today's trading session. Indus Stars, they reported a weak set of Q3 earnings on a sequential basis, the first ever loss that the company reported since its listing. Let's understand all of the details on the quarterly earnings. Somit joins in with the details. Somit?
Well, it was a howler. In fact, a very disappointing set of numbers reported by Indus Stars. If you see the company's revenue, they were down nearly 15%. EBITDA declined by around 59% on a sequential basis, while the company reported its first ever loss of close to 700 crore rupees since it was listed on the exchanges. And this loss was owing to a weak core business performance and higher provisioning reported by the company in the third quarter. Now, provisions in the third quarter stood at close to 2,200 crore rupees, and this is regarding the delay in payments coming in from one of its key customer, that is Vodafone Idea. In the first half of calendar year, if you see, the company had taken a provisions of close to 3,000 crore rupees, and in this quarter alone, the company has taken a provision of close to 2,270 crore rupees, and the total provisioning taken so far in the 9 months stands at more than 80% of the FY22 profits. Now, this higher provisioning puts in doubt the most attractive proposition of Indus Towers, that is the high dividend payout that the company used to do. Now, if this provisioning continues to remain higher, it will lead to negative operating cash flows, which will mean that the dividend payout could in fact be lower for Indus Towers, and that could keep the share prices under pressure when it comes to Indus Towers as a stock. On the performance side, if you see, business performance side, if you see, the tenancy addition was lower at around 1,300 as compared to 1,700 reported by the company in the previous quarter. The energy EBITDA continued to remain in the negative territory, while there was an exceptional loss of 500 crore rupees that the company had to recognize in this quarter due to reversal of excess revenue reported by the company in the previous quarter. Now, the company will be holding its conference call at 2:30 today, and the key thing to watch out for from that call would be the management commentary coming in for the recovery of dues from Vodafone Idea. What is their growth outlook going forward? What is the outlook on dividend payout? And what is the management commentary coming in on rental renegotiation and tenancy growth going forward?
Right. Okay, we'll leave it at that. Somit, thanks so much for highlighting all the stocks which are going to be in focus. But let's keep it with that. Lots of numbers to crunch and for the markets to digest once they open for trade. So let's welcome on board Nitish Mittal Sen, the JMD and CEO at Nazara Technologies, joining in on the show right now. Nitish, hi, morning. Great to have you today on ET Now. I was just going through your numbers and, a bit of a dichotomy there, because while you've seen strong growth, margins are weak. Explain what happened.
No, I think, we're very much on track of, how we planned to deliver our numbers. Our business comprises of our early learning Kiddopia business, which is, starting to take off again. Our esports business is where the margins are down, which is kind of clouding the overall margins, to about 9.7% this quarter and 10.2% for the 9 months that, were ended. So I think overall the esports business, is growing at a very fast track. It's a place where we're a market leader, and to dominate that space is very important that we reinvest. So we're completely okay by reinvesting our profits and margins into, market leadership in that particular space, while our other business verticals continue to contribute to the profit margins.
Good morning. This is Nayanthara also joining in on the conversation. Nitish, hoping to also get some forward-looking statements from you on what the markets can look forward to. We will maybe have another gaming IPO. Let's see if it happens. But there is a lot of clarity which doesn't exist at the moment because of regulations that could come in. Now, Nazara also wants to be the info edge for the gaming world by investing in startups. Yes. Are you going to have a funding winter?
No, I think, regulatory clarity is emerging in India. As you know, MeitY has been, actively working on it. And we're expecting that in the next couple of months, more clarity and guidelines will come out, especially to do with the skill-based real money gaming space, which has scaled a lot in India, but still operates in, unregulated waters, I would say. So I think better clarity, better regulatory will actually allow companies like ourselves to aggressively invest, a lot more capital into the business. And therefore, it's a very positive step, very welcome step. And I think 23 will see better regulatory clarity emerge in gaming in India.
Has been the company's, sort of mantra that you prioritize growth over margins. I just want to understand what your target is for margins for the year ahead, and if you could walk us through the outlook on your ARPUs for the e-learning segment, and are you going to increase your marketing spends here?
Sure. So on the e-learning segment, our flagship product is Kiddopia, meant for young kids in the 2 to 8 segment. It's a very popular app. Kids love it and parents love it. And as you would remember in the last few quarters, that business had kind of plateaued because of the Apple privacy policy changes that had happened. However, this quarter we've seen us kind of break out of that, plateau that we had, and the business has started growing again. We've also taken additional price hikes on that product, one more in this quarter in December. We moved in the last 2 quarters from a 7.99 monthly charge, 7.99 US dollars monthly charge, to a 9.99 USD per month, and the market has accepted it well. So we expect to see benefits accrue to us over the next year, and we expect this business of ours to come back to a fast growth track. Like I said, on the overall margins, if you keep aside our Nodwin esports business, our margins are upwards of 15-16%. But at a comprehensive level, when we include our esports business, which is on a fast growth track and is investing, our margins are coming in at about 10%. We are completely okay, like I said, with that, because it's very important that we invest for market leadership and creating the moats around us. In Nodwin, we have kind of created a 360-degree approach on esports. We are covering, you're putting the gamer in the center and seeing everything that he wants to, do. We've launched a gaming accessories business in the last 2 quarters, which has done very well for us. So I think if you're growing at the pace we are growing without, burning cash, it's a great place to be.
Sure it is. And, I just want to talk about your FY23 revenue growth guidance, which you've clearly upped from 50% all the way to 70 to 75%. But you've also moderated your EBITDA margin expectation from, 12 to 13% earlier to now 10%. So is that a clear choice? It's going to be growth versus margins, or do you stand to revise your guidance anytime soon?
No, I think we are going to stick to our guidance for this year. The whole idea is to grow, prioritize growth, because we really need to scale our business. We can optimize for margins at a later time, and we will do that. I think the only guardrail we've kept for ourselves is we do not want to burn money, or we do not want to drive growth with losses. As long as we are growing very fast while remaining profitable, I think we are okay.
Nitish, before we let you go, we've got that big event on 1st of February. Would love to get your views from the union budget, because in the run-up to the union budget, what we have seen is a CBDT chairman on record, on camera, say the budget is going to plug loopholes when it comes to any kind of tax evasion and online gaming. We saw last year how consumers were told to update their income tax returns. It wasn't a great year for the online gaming world, for the kind of rules and what all was going on. What are your expectations?
Yeah, I think the key word here is clarity. I think, the taxation should be what is right, what is a balanced approach, and I'm sure the government will do that. As long as clarity emerges, I think it will be a very positive sign for the industry.
Okay, so clarity, clarity, clarity. No grey in the union budget, only black and white. That's, of course, what all of India Inc. and all Indians want. Nitish, it's always a pleasure talking to you. Thanks so much for being live with us today and giving us the first interview post the earnings.
Thank you. Take care. Bye.
Okay, let's talk about some of the buzzing stocks. And yesterday clearly belonged to Tata Motors as well as Maruti also. Both those stocks held out very smartly. A good 3.5% move is what you saw. Naresh, you think the year could belong to Tata Motors, as the previous one was clearly in favor of M&M and TVS?
So I would wait out for some more price action to confirm that. So if you look at the last almost a year and a half, or say roughly from last October 21, the stock has been around that 440 mark roughly as the average price. The stock did see a big gap up in that time. It went up to 530 and has drifted lower to 380 multiple times. Over the last 1 year, it has made 4 bottoms around the 380, 400 mark. And yesterday it closed at 420. So 440 is that pivot point. And if it starts sustaining above those levels, that would be an indication the trend has changed. So for now, waiting out. But yes, after a 1.5 year or more of consolidation, there is a possibility the stock can come back. And the stock has a tendency to do that every time it has made a move. So even in 2020, after the initial move, it consolidated for almost a year and then the next leg came in. So would be watching out. As of now, waiting for price action to confirm that.
Which are the stocks on the editor's radar? We're in the thick of the earnings season, but cannot let Adani Enterprises surpass. So let's begin by talking about that, as well as some of the other consumer-facing stocks, all in the spotlight on the back of numbers. The likes of Pidilite, United Spirits, Asian Paints, and Nikunj, we brought this up at the get-go. Some of these consumer-facing companies clearly have faced the heat when it comes to their quarterly numbers, be it a rise in input costs, be it demand slowing down, and they've borne the brunt.
Good companies at an expensive price is never the secret sauce for making money, at least in the short to medium term. I think some of these names, and especially Asian Paints and Pidilite, they fall in that category. These are great franchises. Asian Paints as a business, Pidilite as a franchise, brands which they own, they are great businesses. But in last 2 quarters, there seems to be a visible slowdown, which I think is visible in some of these companies. The quarter gone by, even though it was a great peak quarter for the paint demand, Diwali Dussehra sales, nothing really translated into the volume growth. Similarly for Pidilite, numbers came yesterday, nothing strong. United Spirits, it's a miss on all counts. These stocks have done exceedingly well and they've been wealth creators. My sense is that typically when stocks are expensive and when growth gets compromised in the short to medium term, the stocks, they tend to underperform. We've seen that with Bajaj Finance, great company, decent growth, but it's the expensive valuation and fear of a slowdown. What you were in the past versus where you are headed in the near term will lead to some changes in terminal value. There are some fund managers who will come out and say, okay, think 5 years out, but I don't know about 5 years. They may come back if the cycle changes. But next 3 to 6 months, I'm going to stick my neck out and say that some of these stocks now run the risk of underperforming, especially Asian Paints and Pidilite. Look at the 52-week change there, and you're getting a sense that these stocks are getting, they're not Humpty Dumpty, Avan, so they don't have a great fall. These stocks don't fall, but they will get rusty and they will enter into sideways consolidation.
Fear of a slowdown, expensive valuations, and that is going to be critical for some of these companies' underperformance. Okay, let's move right on then. And like I said, can't move on without talking about Adani Enterprises and Mammoth FPO. The anchor allotment today, we know in terms of what they're using the proceeds for the 20,000 crore rupees in terms of their overall debt repayment, etc. But since the FPO pricing was announced, the stock has seen a bit of a decline.
Yeah, so let's first introduce the IPO, 20,000 crore discount, large IPO. What will be the proceed? Well, it's an Adani IPO. These stocks have been massive wealth creators. Adani Wilmar has created phenomenal wealth, and now the Adani Enterprise IPO is coming at a discount. The unique part about this IPO is that you only have to pay 50%. Yeah, it's like 50% right now, 50% later, which automatically means that in the short term, that created this arbitrage for investors and for traders that you go short on Adani Enterprises and then you wait for the IPO allocation. And that explains that in last 7 days, why the Adani Enterprises stock, irrespective of what's happened to the broader market, because of this arbitrage, you know that this is the size of the IPO, this would be the price, this would be the allocation. I guess that arbitrage is at play because the discount was there. But for a long-term investor, you have to understand that this company is in all high-growth businesses, especially the 3 businesses. Airport business, which has become large, the clean energy business, which is getting incubated, and infrastructure stroke road, where they are very large right now. The debt to equity ratio of the debt component of Adani Enterprises will always has been a gray area, now gets addressed. B, the promoter holding comes down and the free float eventually increases. The retail guys are getting a chance to buy an Adani stock for a long haul. So if you ask me that where can we stick a neck out and say that whether stock is going to move up or down in the short term, difficult because there's an arbitrage which is at play. But I'm absolutely clear that the group and this company is in the business of incubating businesses. A lot of new businesses will get incubated and they will get listed. So it's like Tata Sons, the company, which is incubating businesses, and those businesses are high growth businesses. So if you're bullish on India, and if you're bullish and if you believe that this decade indeed belongs to India, then it is important to have some of these high growth businesses given where they could be and where the potential could be.
All right, there you have it. That's the take, an entire extensive take on the Adani Enterprises FPO and consumer-facing stocks.
About what we can expect from the markets today and pockets of opportunities. Himang Jani also now here with us. Good morning, Himang. We've been talking about how it seems as if the domestic investors are certainly waiting for 1st of February to be out of the way, and that's why we're not seeing the needle really move when we look at the indices. But I like to focus with you on certain stocks that are standing out. A day before earnings were declared, we've seen Tata Motors go home more than 3% in the green, 3.5%. It's a big indication from the market that expectations are certainly running high. To be fair, even Maruti was higher by 3.5%, Bajaj Auto was up nearly 2%, but Tata Motors specifically, fundraise, maybe acquisitions in the anvil, a listing too.
Yeah, good morning, Nantara. I think Tata Motors off late has seen some resilience, and I think it's because of two or three reasons. One is that the on the domestic side, the CV business and passenger vehicle business is shaping up pretty well. And you had some incremental positive news on the JLR front, particularly because China is opening up, and globally also things are looking a little better because of the uh, better developments on the chip shortage front. So I think that's what is leading the performance of Tata Motors. I am not really relying too much on the numbers because if you see numbers, they have been quite bumpy, and it would provide a good short-term trade. I think basis the recent guidance by the management on the net debt and the overall margins. So to that extent, Tata Motors being a high beta stock, you can play for a 8 to 10% kind of an uptick. But yes, Maruti and Mahindra are far more sustainable stories, and we would really take a 1 or 2 year bet on it. We've seen improvement in the performance, margins, the acceptance to some of products has been great. So those are the more high conviction long term bets from our side.
Okay. The talking point is the dollar index. Himang, while everybody is talking about budget, tax, my limited view is that why is there nervousness in the ahead of the budget? Let's look at the track record of last two budgets. Clean budget, no changes in tax structure. Very simple in terms of where the government wants to, pockets where government wants to kickstart growth. How the multiplier effect is getting created by extra spending in infrastructure. How fiscal deficit number is something which is manageable. Disinvestment numbers have been very conservative and realistic. If past track record is anything to go by, there's a big departure in the way how Indian budgets are tabled now. And yet market nervousness this time seems to be extreme ahead of budget.
So, Nikunj, I would not attribute this nervousness or a bit of an underperformance as far as Indian market is concerned entirely to budget. I think it's more to do with our valuations and the way alternative markets are emerging as a much better play when it comes to FI flows, and which is what we have seen that a large amount of selling has happened in our markets. As far as budget is concerned, Nikunj, I think government has done a credible job in the last 2 years, and the way they've managed the entire capex push, despite the issues around COVID and the fiscal deficit, that's quite commendable. And we think that by and large they would really continue with that. Just that because you have 1 year to go before general elections, you might see a bit of a populist push that could be a bit of a negative as far as sentiment is concerned. But unless we see some major thing on the capital market front in terms of the rate of tax change or STT related changes, I don't think the market would really take it negatively.
Right, okay. Those are the takes coming in and what to anticipate from the budget. But Hemang, you were just talking about the auto numbers. Wanted to understand what is it that you've made of banks? And especially, whether Kotak, ICICI Bank or any other is going to win this race of retail loan growth.
So Aisha, when it comes to banks, we are dealing with the problem of plenty. What is happening is that most of the banks are delivering good numbers. And the issue is that because of the over ownership, let's say in case of ICICI Bank or State Bank, or for that matter, HDFC Bank, performance is not an issue. But I think given the over ownership and the fact that these being the large holdings for some of the FIs, and there has been a relentless selling that we have seen, that is what is actually causing some impact in terms of performance. But our take is that this entire space will continue to deliver for next year on the back of much better, loan growth and the operating metrics. And our preferred picks over there across private and PSU banks would be something like Axis Bank, uh, IndusInd Bank, and also State Bank, and to some extent, Canara Bank, BOB, etc. And we would have an overweight position given the strong visibility which is there.
So, Hemang, while we're talking about banks, and we've focused right now on the large private sector lenders, and you've spoken about SBI, what about the smaller banks, Hemang? We've seen a huge run-up in prices, a valuation run-up that had taken place. There is now a view that maybe the best is behind us, even though the balance sheets have never looked better, or that we could be in for some kind of a correction. Do you subscribe to that view?
I think the smaller banks' performances have been good. If you look at, something like a Bank of India or a Union Bank and maybe a few others, performance is not an issue. The issue is that, how many you can have in the portfolio, because there are too many, and, valuation-wise and business model-wise, more or less, they look the same. So we have to really, decide which ones to go with, what sort of allocation you want to give to a smaller bank versus larger banks. So we do like some of these names, and the re-rating story is going to continue for at least, let's say, 6 to 12 more months in terms of ROE expansion, ROA expansion, and the fact that valuations continue to remain good. So yes, looking good, but be more selective rather than broad-based.
I'm looking at two interesting graphs here, and let's look at the 5-year chart of Tata Motors. I've said this before that the stock is actually flat. Hemang, take a wild guess. What do you think Maruti has given in terms of return in last 5 years? Has it managed to beat Tata Motors, or it has underperformed Tata Motors?
My take is that, Nikunj, Maruti would have done slightly better than Tata Motors, though, because of the steep correction that we had seen, point to point, it may not look that great, but from a, strong correction that we've had in between, the bounce back for Maruti has been quite sharp. So from that point, the return would have been much better, but over a 5-year period, it may not be that great.
Naresh, without looking at your laptop and doing a chart search, 5-year, which stock is done better, Maruti or Tata Motors? And don't look at your laptop.
I think it is Maruti which has done well.
See, Rudramurthy?
I to go with Maruti.
No, it is Tata Motors.
5 years?
Yes. 5-year return is actually Tata Motors. And imagine if Tata Motors has given no returns in last 5 years, Maruti has also given no returns in last 5 years. So Hemang, Tata Motors has a JLR problem. They have a problem of China. They have a problem of Brexit. They have a currency issue. The stock has not given any return, fair enough. But 5 years, nothing's gone wrong for Maruti that it has given no returns.
So Nikunj, actually, if you see Maruti, 3 years back, the P multiple that Maruti got was more than 30 times. And in between, we had this auto, growth actually slowing down quite a bit, and Maruti bore the brunt because they did not have the relevant products where the growth was far better. So in the compact SUV and SUV category, they had a, issue, and which is what led to some sort of an underperformance. Also, we had this margin related issues. But now at this point, what we feel is that a large part of those issues are resolved, in the sense that you have a good product basket, the performance is really looking much better, margin part is more or less okay. Now we've seen improvement in the margins as also. So I think from here on, for next, let's say 2 years, Maruti could be one interesting stock to look at, and it can give you a 20-22% kind of a return.
Okay, Hemang, stay with us. In the run-up to the budget, we caught up with Ronnie Screwvala, chairperson and co-founder at Upgrad, who believes that 100 million for the next 200 million jobs in India will be created by startups. He says that skilling is critical for India to be job-enabled.
He's the original risk taker, a wearer of many hats, from entrepreneurship to education to even non-profit. Join me, Avan Dabash, as I interact with Ronnie Screwvala, the co-founder and chairperson Upgrad, as we discuss his outlook on the upcoming budget, the future of startups, and the India story, only on ET Now.
Really the element of skilling and jobs. Because I think in India, that's a massive challenge. We can talk about GST, we can talk about taxation, but at the core of it, we need to be a much more higher skilled nation than we are today. And there's a lot that needs to be done there. For us to be job enabled, forget about the fact that where will the next 200 million jobs come? So that whole ecosystem, and I think a budget can be a great turbo booster. And I think the last two budgets, the focus on education, the focus on skilling has been very much part of the budget. So I see this as a very important continuum where India has to be a much more higher skilled nation for intellectual property and for thinking, not just masonry and carpentry. That will lead to the 200 million jobs. Connected with that is, yes, Startup India, which was a massive campaign that the Prime Minister evangelized. And I think if you connect the dots there, 100 million of the next 200 million jobs are going to be created because of startups. And, you know, not unicorns, unfortunately. We should take that out of the spectrum because they actually go up and then they fall as sharply as they go up. So I would just take the unicorns off the table. It's a chest-thumping moment for 9 investors and 4 founders. But really, the Startup India is not the ones you read in the media. They're the people behind the scenes. They're creating and changing lives and jobs. And they will create that.
All right, that's an interesting discussion. You can hear out a slice of that conversation at 10 a.m. with Ronnie Screwvala. In the meantime, let's just get in a view then from Hemang as to what the outlook is when it comes to the entire cement sector. Because, Hemang, one can't ignore those pricing pressure or cost concerns that were flagged off by Ultratech Cement. Just a couple of days ago, we saw the entire sector as well reel under pressure on the back of that. What's your sense as to how one should position themselves within cement? Will you be very specific, sticking to some of the large cap names? How are you looking at competition as well, heating up here?
So, Avan, the numbers of Ultratech and a couple of more cement companies have not been that great. I think on the realization front, there is a clear disappointment. Also on the margin front, things are not looking that great. So our take is that short term is going to be a little difficult for cement companies, let's say next 1 quarter or so. But at some point, you will see a good bounce back also. Because, if you see, let's say next 6 months or 12 months, there is going to be a decent amount of pickup that you will see across the government and the private side, and that would lead to some improvement in the realization as well. So, Ultratech remains our preferred pick in the large cap space, and in the mid cap, we like Dalmia and JK Lakshmi Cement. I think one has to have a decent amount of allocation towards cement sector, given that the operating leverage play over here is going to be very, very interesting.
Okay, now it's that time of the show as well where we go across to our chartists and get all of you, our viewers, ideas, money-making ideas from the broader markets. Nuresh and C. Rudramurthy, coming to you now. Nuresh, you go first.
So I'll stick with my view on Birlasoft. That is a stock which has seen a breakout over the last 2 sessions and has seen the maximum correction of almost 45 to 50% from the top. So has a good possibility to make a quick bounce back. So continuing with the view, a stop loss now at 298 and a target price of 330.
And C. Rudramurthy, what about you?
I'm giving a buy call on Onward Technology. Again, if you see the chart patterns, this stock has taken support at levels of around 300 to 310 zone, and it has been that one stock which has performed so great for last 3 to 5 years. In fact, from 60 rupees, this stock is just moving upward and it has further space to go up. So for me, this is a buy on any dip. Have it in your portfolio, looking at targets of 400 initially with a stop loss of 300.